Hey guys, welcome back. In this particular video, we are going to talk about Forex market, which is foreign exchange market. Okay, whenever we talk about foreign exchange, it is one of the largest financial market in the world. Okay, so here we are generally going to talk about what is Forex market, what are exchange rate, and we'll talk about Indian forex market, and we'll talk about direct quotation, indirect quotation, chain rule, and other terminologies as well. Okay, so whenever you talk about foreign exchange, it is, as I mentioned, it is one of the biggest, it is one of the largest financial market in the world. If you see the tradings, okay, so we have number of currencies pair where we generally exchange one currency with another. Okay, even if you talk about the in context with the Indian forex market, so RBI will generally regulate this market, and we have a separate act which is known as a Foreign Exchange Management Act 1999. So we will discuss these particular points in this video, and at the end of the video you'll have a clear cut understanding toward these particular topics. Okay, if you're new to my channel, please do subscribe and do like the session. So first one is, now we will start with what is foreign exchange. I hope most of you know about foreign exchange thing. So Forex, which is a stand for foreign exchange, and when you define foreign exchange, it is like you can say it is a trading of one currency for another. Okay, let's say if you want to convert Indian rupee into US dollar, so we have some rate. So that rate is generally known as exchange rate. Okay, so for $1, how much Indian rupees you need to pay. So that, or for that particular transaction, we have a place. That place is generally known as foreign exchange market. Okay, so if you go through the definition, you'll get more clarity about this. So foreign exchange is the trading of one currency for another. As I gave you an example of INR and USD, or you can say USD INR, USD Euro, USD Yen, or INR Yen. So these kind of transactions. Okay, so if you have to convert your currency into some foreign currency, so that transaction that generally take place in foreign exchange market. So one can swap the US dollar for Indian rupees, or that transaction will take place in foreign exchange. So foreign exchange transaction can take place on the foreign exchange market, also known as Forex market. So where basically we exchange these particular currencies, that generally known as foreign exchange market. Okay, as I told you, in India it is generally governed by RBI as per RBI Act 1934, and we have FEMA as well. Previously that is called FERA. So we'll come to that particular point as well. Now, what is exchange rate? I hope now it is clear to all of you. So exchange rate is the rate at which we are generally converting one currency, or we are swapping one currency with another. Okay, so that generally known as that generally known as your exchange rate. Let's say for one US dollar you need to pay 81 rupees. So this particular, for $1 you have to pay 82 rupees or 81 rupees. So this is exchange rate for this particular USD INR currency pair. Okay, for let's say for one US dollar you have to pay 0.50 pound, or similarly with other currencies as well. So this particular thing is generally known as exchange rate, which means the rate at which we are generally converting our domestic currency in foreign currency, or we are converting one currency with another one. Okay, so exchange rate is the rate at which one currency can be exchanged into another currency, USD into Euro, USD into INR, or some other currency as well. In another word, value of one currency in term of other currency. Okay, so hope this is clear. Now you have an example as well. So for one USD, suppose that you have to pay 82.43 INR. So this particular thing is generally known as your exchange rate. Okay, for one USD you have to pay 82.43 INR, which is generally known as the rate of or we can say this is generally known as exchange rate. Okay, so hope this is clear. So, exchange, as I told you, exchange forex is one of the largest market in the world. If you talk about the financial market, so we have number of, like, if you see on daily basis trading volume, that is very high. Okay, or even like we do import exports. So during import export, we need forex market knowledge, or we generally, let's say, if you are importing goods from US, so you have to make payment in US dollar. Okay, so you have to pay in dollar, so you'll exchange your INR into dollar. Let's say you are importing goods from China, so Chinese currency is yuan, so you have to convert your INR into yuan. So for that particular thing, we need foreign exchange market. Okay, and foreign exchange market, and on which rate we are generally converting our currency or one currency into another, so that rate is generally known as exchange rate. Now we'll talk about Indian forex market. Okay, so if you talk about Indian forex market, as I earlier told you, so this market is generally governed by RBI, Reserve Bank of India, and the provisions or the governing, like RBI is generally known as custodian for exchange. Or even I hope you guys heard about, like, so many times you guys heard about the RBI disclose the reserve. So when they disclose the reserve along with gold and other government securities, they do mention about the foreign exchange reserve as well. Okay, so which is around 600 billion US dollar as per the union budget. Okay, so Indian, now the method which we generally use, basically the pricing of the currency pair is totally depend on the demand and supply, but the method was generally previously, which we adopted in 1992, that was called liberalized exchange rate management system. Prior this, we have like RBI, they generally cap the currency pair, like US, this is the maximum price for the US dollar and this is the minimum price, so they generally give you a band. So in between, basically you have to bid for the foreign currency. But nowadays we have open economies, so that totally depend on the market factors, which means demand and supply. Okay, and FEMA Act, which is very active toward the foreign exchange related things. So, Reserve Bank of India is custodian of currencies, foreign exchange reserve in India, and is vested with the responsibility of managing their investment. Okay, so let's say, like, there are so many legal entities who are registered with Reserve Bank of India. Okay, so like, let's say if you want to do exchange related business, if you want to help people or investor to exchange their currency with other currencies, so you have to register yourself with RBI. Okay, so the legal provision governing management of the foreign exchange reserve are laid down by Reserve Bank of India at 1932. So the guidelines or the activities which are generally comes under RBI Act 1934, sorry. Okay, and along with this, we have an special act that is generally known as FEMA Act, Foreign Exchange Management Act. So prior the method, now like we have this liberalized exchange rate management system. The Reserve Bank of India used to fix buying and selling a rate, and the market would remain within the ceiling and the floor. Okay, so right now we are using liberalized exchange rate management method. It was introduced in 1992 when we open up our economies with the LPG model. Okay, so prior this particular model, RBI used to seal, or RBI used to fix the limit. Okay, let's say for $1, for one USD, it is like the upper case is suppose that 84 rupees and the lower case is 82 rupees. So this way RBI generally manage these particular things. But nowadays we have open economies, and the pricing are that generally change on the market demands or market supply. Okay, so however, at present the forces of demand and supply in the local interbank market derive the exchange rate. So what is the demand? Like, let's say if there is a high demand for US economy or US dollar, so the prices of dollar will goes up. Okay, and even if there is a high demand for European economies or euro, so the prices of euro will goes up. Okay, so this way, or this particular thing is generally known as market factors. Market factors means demand and supply. So if there is a demand for any economy or any currency, so their currency prices will goes up, and if there is a supply for that particular currency, so their prices will goes down. Okay, so but prior this, we have like RBI have to, RBI they generally fix this particular thing. Okay, but now we have liberalized exchange rate management system, which totally work on the market factors. Okay, along with this, for the regulation purpose or for the protection of investors, we have FEMA Act. So a resident person are permitted to undertake forex transaction only with authorized person. Okay, authorized person, they are generally registered with RBI. So authorized person are entities who are generally registered with the RBI, and they generally deal in the business of foreign exchange, and permitted and for permitted purpose in term of Foreign Exchange Management Act. Okay, so authorized person or authorized dealers, they are generally known as authorized person or authorized dealers. So they are generally registered with RBI, and they work as per the guidelines of RBI, and RBI generally give license to these particular entities, authorized person as a authorized dealer, and they work according to the guidelines of FEMA, Foreign Exchange Management Act. Okay, so even like let's say if you are planning to go abroad after 6 months, so you can buy some foreign exchange like if you are planning to go US, so you need dollar after 6 months. Okay, so if you have some kind of prediction that after 6 months prices of dollar will goes up, so you can buy today as well. So you have exchange where you can procure these particular currency pure. So we have open market, and we have lot of options to invest or to procure these particular dollars. Okay, or some other currency as well, and that where you will generally deal for, or where you will do the transaction, that market is generally known as forex market. In India it is governed by RBI, and we have a separate act that is generally known as FEMA Act. Okay, and those who generally participate in, like if you visit some airport area, I hope you guys must seen there are some entities who generally offer, who generally exchange the domestic currency in foreign currencies. So they are generally called authorized dealer, and they have given license by RBI only, or they follow the guidelines of RBI as well as FEMA. Okay, so hope this is clear. Still, if you have any query, please do mention in comment section. Now we will talk about factors determining exchange rate. Like as I told you, like for $1, let's say you have to pay 82 rupees. Okay, so what are the factors which will generally lead the prices? Like after some time, let's say there are some factors, or there are some factors outcome. They are saying ki after 2 months, for $1 you have to pay 80 rupees only. Okay, or you have to pay 86 rupees. So what are the fundamentals? What are the factors behind this? So we have majorly two type of analysis. One is fundamental or fundamental reason or fundamental analysis, and another one is technical analysis. Okay, so whenever you talk about fundamental, it is something related to it is something related to the economy. Okay, so currency which generally represent an economy, let's say INR, Indian rupee. So the performance of INR that mostly depend on Indian currencies, Indian economy's performance, or the performance of US dollar is basically based on the US economy, how US economy is doing, what is like their trade relations. Okay, what is their like economic activities like fiscal policy, monetary policy. Similarly, in India as well. So if you see the performance of Indian currency INR, so the basis are the how Indian economy is getting the strength in the market. Okay, let's say if there is more investment in Indian economy, which means there will be demand for INR. So the INR will get some power. Okay, so if there is more production in Indian economy, which means we'll make more export, which means there will be a demand for Indian economy. Okay, so or even the political stability and all. So these are fundamental. If you talk about the technical, so sometime like you study the charts and all, so some like there is some news, some war conditions, so these kind of things, or the customer sentiments, so they generally lead to the technical analysis. Okay, so first we'll cover the apart from technical and fundamental, we have speculation as well. So speculation is kind of like the expectation after 3 months the dollar of prices will the prices of dollar will goes up. So this is a speculation. Okay, so we are making our decision on the basis of future movements. Okay, so that kind of thing. After 3 months, Indian economy will get some strength, so the prices of USD INR will come down. So this is a speculation. Okay, so but majorly the reason are fundamental and technical. Okay, and it is more toward to fundamentals if you go for the analysis of any currency. Okay, so fundamentals which include balance of payment. So if you have strong balance of payment, or you can say if you have surplus balance of payment. Now what is balance of payment? It is basically our activities are like monetary transactions with other countries in terms of foreign trade and remittances. Okay, so let's say if your export is greater than your import, which means your credit amount is greater than your debit amount. Okay, so which means it will give a boost to your economy. So that is definitely going to help your currency. Okay, so balance of trade or balance of payment is surplus, so it will generally lead to stronger your currency. Okay, economic growth. So if we have a positive sentiment about that particular economy, so that means if there is a economic growth, or if there is a if there is a prediction about the high economic growth, or even in past they perform well, so that will generally win the trust of investors. They'll invest more money in our economy. So if money is coming, so they have to convert in INR, so it will create a demand for INR. Okay, fiscal and monetary measure. So again, like how we are tackling the deficit financing, how we are generally managing currency and inflation level, so that is again going to help. Interest rate. So how is the interest rate appearance in that particular one? Short term again we can say. So political issues. So if we have a political stability, which means our guidelines, our rules, regulations will remain constant for a time being. Okay, so that generally help. Like even like if you have a stable political if you have a political stability in your economy, so which means that investors they'll have more trust on your economy, because your policy of that particular government remains same for a longer period. Like you can take an example of Indian economy from 2014 to 2013, 2023 we have NDA government. So which means for this long period, for more than 10 years, we have a single government, which means their policies are same. Okay, so that will give strength to your currency. So fundamental reason, which is generally related to your economy or your economic performance. Hope this is clear. Technical, government control can lead to unrealistic values. Sometimes government they come with some kind of restrictions on some trade or some things. So these kind of things they also affect the exchange rate. Free flow of capital from lower interest rate to higher rate of interest. Okay, so if there are some changes made by government or monetary authority in interest rates, so that also affect your currency. But these are like if you talk about the fundamental effect, they have a long term effect. But if you talk about the technical or speculation, they have a short term effect. Okay, so speculation, the higher speculation, higher the volatility in the rate. Volatility means the changes or the fluctuation in the prices of exchange rate. Okay, so if there is a high volatility, so you will find like this, the graph of the currency or the graph of the exchange rate will be like this. Okay, like let's say if there is a war condition, if there is a world war condition, so there is a high volatility, so there will be this kind of movement in the exchange rate. Okay, so hope guys these particular things are clear to all of you. So what are the key factors which generally determine the exchange rate? Okay, so if you have any query about any points, do mention in comment section. Now we'll talk about the direct and indirect code. So what are direct code and what are indirect code? And this part is very important for your like sometime examiner they generally ask question based on direct and indirect quotation, and when we'll do the cross rate, when we'll do the conversion of currencies. So this will generally help you. Okay. So whenever you talk about the direct quote, so direct quote is when one unit of foreign currency is expressed in term of domestic currency. Let's say for one USD, you have to pay 82.43 INR. Okay, 82.43 INR Indian rupee. So this is called your direct quote. So this is generally known as direct quotation. So indirect is when, let's say, for 100 rupees, or 100 INR, you will get, suppose that 1.10 USD. So this is generally known as your indirect quotation. Okay, most probably, like if you, when you'll trade in the market, so you'll find we generally use direct quotation. Okay, here you can go through the definition, you'll get more clarity. So the quote is direct when the price of one unit of foreign exchange currency is expressed in term of domestic currency. Let's say for 1 euro, you need to pay 92 rupees, 92 INR. So this is generally known as your direct quotation. Indirect, the quote is indirect when the price of one unit of domestic currency is expressed in term of foreign currency. As I mentioned, let's say for 100 INR, you need to pay 1.11 US dollar. Okay, so this is generally known as your indirect quotation. Okay, so when you trade in the market, you'll find these kind of things or these kind of terminologies. For do remember. Okay, so I'll give you an example as well. So the rate are quite old. If you see these particular rate, you will find in 2018-19. Okay, so for direct quotation is for 1 USD 78.18 rupees. For Great Britain pound, one you have to pay 103.66, and euro, 1 euro you have to pay 88.95 rupees. So this is called your direct quotation. If you see in direct quotation, so here your base currency will be INR. In this particular one, your base currency is foreign currency. Here in case of indirect quotation, you have a base currency, that is INR, which is so for 100 INR, you need to pay this US dollar and this pound and this euro. So this is called your indirect quotation. Hope this is clear to all of you guys. And this is very simple one. Okay, so you can easily relate this one. If you like, so many time, I hope you guys also observe this particular thing. When you generally study the forex market, or when you read the news about the export import things, so you will find one currency that generally dominate that particular one, which is US dollar. Okay, because like if you see, let's say for if you talk about the US rupee, sorry, if you talk about Indian rupee, which is INR, and Chinese currency yuan or renminbi. So we do not have any direct quotation. Okay, it is also known as renminbi. So we do not have any direct quotation, like for one INR, how much yuan or renminbi we need to pay. We do not have direct quotation. So in that particular case, we generally use cross rate, which is first we'll convert, like for one INR, how much US dollar we need, for one US dollar, how much yuan needed. So that is, we have this particular one. Okay, so in this particular case, first you will convert INR into US dollar, then US in renminbi. So this is, most of time you will find this kind of exchange in the market. Since the US dollar is the most dominant currency, usually the exchange rate are expressed against the dollar. Okay, so most of time you will find this particular thing. Okay, however, the exchange rate can also be quoted against other currencies, which is called cross rate. Like we have four major currency pair, like your USD INR, we have euro INR, we have yen INR, we have pound INR. Okay, apart from that, we usually go for the cross currency. Cross currency, as I gave you an example. So let's say we do not have INR renminbi pair. So first we'll convert INR into USD, then USD, because renminbi and USD they have a pair, and USD and INR they have a pair. So we can easily convert that particular one. Okay. So hope with this you also get an idea about cross rate. So we'll go through the definition, then I'll give you an example. So if a person want to remit euro from India, and as a banker, and for argument's sake, okay, for INR and euro we do have, so you can consider it as a renminbi, okay. So RMB, or you can say any other currency like baht and all. We do not have direct quotation with them, okay. So rupee, euro are not normally quoted. So this is for argument's sake. Please do consider this. And therefore, what we have to do first, buy dollar against the rupee, and the same dollar will be disposed of for the overseas currency, which is euro. So this example is, as I gave you an example, as I told you, for INR and renminbi, we do not have direct quotation. Okay, we do not have the fixed exchange rate. So in this particular, but we do have INR. They have a common currency USD, and renminbi, they have a common currency of USD. So first we'll convert INR into USD, then we'll convert USD into renminbi. So this exchange is generally known as cross rate, or this exchange rate is generally known as cross rate. I'll give you an example as well, okay. So go through this example of US dollar. If the Mumbai market, 1 US dollar equal to 78.18, and the London market is for 1 US dollar, euro is 0.833, okay. So 0.83, sorry, we will get 1 US dollar for this amount. This means this, okay, and this means this, okay. You will get 1 US dollar in 0.833. So how many rupees equal to 1 rupee? 1 euro. How you will calculate this particular one? If 0.83 euro equal to 1 dollar, then 1 euro equal to 78, because 1 dollar 78.18 divided by 0.833. So your answer will be 94.19. So now this is a very simple calculation, guys. You just need to understand the cross rate rule. Okay, here when we do not have direct amount, like for 1 US dollar you need to pay this much of amount, for 1 euro you need to pay this much of amount, but for one yuan or for one renminbi, how much amount we need to pay, we do not have that particular thing. So in that particular case, you'll adopt the cross rate thing. So first you'll convert INR into dollar, or you can go vice versa as well, okay. If you need euro, so if you need yuan, so first you'll convert INR into dollar, into your next currency, which is yuan, or third currency, which is yuan. So 1 euro equal to your because 1 euro equal to 0.83 $0.83, and $1 equal to 78.18. So 78.18 divided by 0.38, so your outcome is 94.19. So this way you can calculate your cross rate as well. And believe me, so many times examiner, they generally ask question based on cross rate, how to calculate and all. So please do remember this thing, okay. Now the transaction, this entire journey, we have a chain. First INR, the chain is USD, and then we have renminbi, okay. So we converted INR into renminbi because we do not have direct quote, so we use help of USD. So this method is generally known as chain rule, okay. So many times, guys, again this is very important one and very basic concept. So what is chain rule? So when you using cross rate and you using a third currency, which is most of time US dollar, as a medium to exchange with other currency, so this activity or is that generally creating a chain, so that is generally known as chain rule. So the fixing of rate of exchange between the foreign currency and Indian rupee through the medium of some other currency, as we use dollar, is done as known as chain rule. So the rate thus obtained cross rate between these particular currencies. Hope this is clear. So this is nothing like, as I gave you an example of US dollar and yuan. So we have to convert INR into renminbi, but we do not have a direct quotation. So we use US dollar as a third currency. So first you will convert INR into dollar, then dollar into renminbi, okay. So this activity or this entire transactions or this particular system is generally known as chain rule in Forex market. Okay, so hope this is clear to all of you. Guys, in next video, we will discuss the remaining things like value date and forward contracts and all. Okay, so in this particular video, we generally talk about what is foreign exchange market and what is exchange rate, and even we talk about the Indian forex market and the basics things like quotations, direct quotation, indirect quotation, chain rule, and cross rate. So these are very important points for your examination purpose. So please go through these particular point. If you have any query related to any point, do mention in comment section. I'll get back your queries. Okay. And if you like, so please do share with your friends. And if you are new to my channel, please do subscribe. Thank you for the watching this video. Happy learning. Thank you.